Right. Good morning, everyone. Sorry about that bit of a technical issue. My name is Kaushik Chakravarti. Thanks, everyone, for joining. And welcome to this discussion about the future of correspondent banking. To start this off, maybe we'll start with a quick round of introductions.
Sure. Good morning, Aaron Zinzek. I'm with M&T Bank. And in my world, I've got foreign exchange and trade services.
And Matt Luce, I'm at Scotiabank, and I manage our wires clearing business and the network management team as well.
And good morning. My name is Rich Mazzaros. I lead the Visa Direct business for North America. Visa Direct is the domestic and money movement capabilities within the global Visa network.
Perfect. Thanks. Just to start off with, maybe we'll start with a quick context. So correspondent banking, as you might understand, the model has been going through an environment of change. In today's day and age, even over the last several years, we've seen a lot of complexity within the environment. And we talk of de-risking, we talk of geopolitical tensions, which also leads to a lot of sanctions enforcement, as also leading to a lot of AML and compliance costs that have been escalating. The other aspect of the complexity is also emanating from a change in customer behavior as well, right? We see a lot of clients and customers' expectations change over time. They look for the next automation. They're looking for transparency, cheaper cross-border payments, a lot more. So in that context, what we are going to explore in this discussion is to understand how that impacts the future of correspondent banking as we know it. The idea is to not sort of look for disruption for the sake of disruption, but to identify where we are at this point of time from a value creation perspective from a correspondent banking model, and delve deeper into what are the current complexities, what are the new age alternatives, and whether they act as a complement, whether there are new rails that need to be adopted. And finally, the intention is to explore and hear from the panelists as well, to understand where we see the future in the next, say, 5 to 6 years. There's a great diversity in the panel today, so maybe we'll delve right into it. Maybe first question I could pose to you, Matt. In the current scheme of things, as an institution, I'm sure you are used to buying or purchasing services from correspondent banks. Where do you see the value being added by correspondent banks today?
Yeah, I mean, I think it's important to see the journey we've probably taken in my career, right, where we've come with GPI and other things to a much more transparent ecosystem. In the end, if you think about other than ISO and other improvements around the edges, the actual model hasn't really shifted massively. You reference in your opening a few things that I think are really critical, which is the risk and compliance aspect of the business has always been there. It's gotten much, much more complicated and more difficult in the recent times. I think the encouraging part when you combine ISO and the new structure and data it will bring, along with new technologies like artificial intelligence and other things, the opportunity to be even more efficient in some of those compliance and control checks are there, which is a very encouraging sign, because the reality is, in the last 10 years, if you're in correspondent banking, you've seen a massive increase probably in your control functions and the number of people you need, right? Peak, as it becomes much more complex on, we went from traditional sanction screening, which was relatively simple, it was a name, to sectoral sanctions and sanctions that are very, detailed in up to certain amounts or certain aspects or certain types of trades, which became very difficult to automate in the old technology, but I think is encouraging as we go to the new technology. And for myself, right, we provide services in our home market, but we buy services as well. And the most critical thing, as we've gone through this transformation, don't underestimate the soundness, safety, security, and stability, right? At the end of the day, in money movement, cross-border, the ability to just have confidence that the money's going to move, it's going to move with speed and precision, is the value that everybody focuses on. And if you do that really well, yes, there's a lot of value you can add with data and other things, but if you do that core foundational basic really well, you're still going to be successful, right? And it's become much more difficult to do that in the current times because of some of the compliance and other things that are out there.
Aaron,
Yeah, and I would add on to that, and I'm kind of coming at this from approach representing the super regional / regional bank space, right, which is a little bit different. Our experience with our correspondents kind of changes over the years. And despite my young-looking picture up there, I've been doing this almost 30 years now. And I remember when I got into this back a while ago, it was easy to get an RMA, get an account set up, do business, have a line. Oh, you need a trade line? Sure, no problem. Here you go. And that evolution as we've gotten to today with the compliance and the risk, and not sometimes something that was in the regional bank space, right? So we had 2023 happen, and that had a big impact on all of a sudden the world was crazy again, and they were looking at regionals and thinking, oh my God, they're all failing. But you move back, prior to that, and some of the big banks had problems, and the trickle-down effect of that was the de-risking, right? So as the big banks would have a problem, compliance would ramp up there, and they'd say, oh, you can't have 600, correspondents. You need to cut a bunch of these. And for the regionals, it started to become more about how much business and volume can you push to cover those compliance costs and the revenue asks of the larger banks. And it becomes difficult because you only have a finite amount of payment flows or trade flows to push out. So you start getting into a narrower and narrower bucket. And then if you're in that small bucket and somebody says, oh, by the way, we need to kick you out, your world gets turned on its head. Absolutely. So it's an interesting take as we talk with Rich and Visa about Correspondent and what could it be and maybe how that helps in some of that space. But to Matt's point, it's a steady, strong correspondent banking network. It's there. It doesn't really break. It just kind of goes up and down.
Awesome. Rich, maybe if you can sort of provide your view on where we see the challenges impacting the correspondent banking world as well. We spoke of increased sanctions pressures, enforcement, a lot more, I would say, compliance costs that are challenging the general model. Is that going to your mind, materially change the model of correspondent banking or the structure and the framework that we have?
Yeah, let me answer that in just a quick second. So I kind of have a different perspective here coming from a network. I mean, Visa is the single largest digital payment network in the world, connecting over 15,000 FIs in 195 countries and territories. And so from that perspective, we don't originate any payments. Right? We just stand at the ready to be able to help banks like yourselves be able to facilitate the payment of those payments, especially in a cross-border environment. And what's interesting around that is when you think about a correspondent network, it is typically a portfolio of a lot of bilateral relationships. And from that perspective, that does inherently have a significant amount of oversight, compliance, and cost embedded in that. Yeah. It also has a level of stability, but also has a level of inflexibility. It's kind of a trade-off, right? Like everything, it's a trade-off. And so the way that, what the role that we kind of play within the marketplace is how do we help kind of facilitate that payment no matter where it needs to go? Because it may be that the beneficiary of that particular payment isn't in your correspondent's account book. It's somewhere else within the country. And that's the approach that Visa takes is how do we help to be able to get the funds to the beneficiary no matter where they are, no matter where they bank, no matter how they bank. And this comes up to the question that was this morning around financial inclusion. Wallets are increasingly becoming an important consideration here in certain emerging markets. If you want to send a payment to a consumer, let's say a B2C payment to a consumer in China, you better offer wallets, right? And so this is the financial product that individuals are using. So Visa's value that we bring and complement in the correspondent model is a pay anyone model, that we can reach any account within the countries that we serve,
Right.
but we also can reach it through a debit rail, which is our internal network, which ultimately is just another pathway into the account, and then into a wallet rail as well. And so through that, we can reach 12 billion endpoints around the world. Now, to your point around the compliance aspect, this is also a place where Visa invests heavily to be able to help augment the bank's own compliance programs. So we have individuals within our regulatory structure that is monitoring the local payment schemes, the local regulations within countries to say, okay, this is what is required to be able to clear a payment within that particular market. So as data requirements change, as aggregation limits change, as anything changes within that market, we become aware of that. We modify the spec that is necessary to be able to compliantly send payments into that market. And then our clients have to accommodate that new spec so that they are then compliant for that payment. So to some extent, it doesn't remove the need for the bank to monitor that compliance, but it's another tool in their tool chest to be able to help them kind of manage what is becoming increasingly more and more of a complex regulatory environment.
Got it. So to summarize, I think what you mentioned also is it's important to understand that even while money is moving cross-border, it is moving to another from point A to point B, but you will still need a correspondent bank at point B to be able to distribute into. So the value creation, as I see it, has moved not just being centralized with the US dollar clearing bank or the euro clearing bank, but it's kind of moved from value creation from the origination to the destination point as well. So to that extent, the model has evolved.
Yeah, it's not just about getting the money in country anymore.
Yeah.
It's about getting the money to the
end
beneficiary.
point. Yeah.
And increasingly, that can mean other types of accounts like mobile
Wallets.
digital wallets, which in certain countries is really significant. Today, Visa connects to 110 digital wallets in 50 plus countries. And that's a significant growth
Right.
channel for not just B2C payments, but also traditional remittance payments, P2P payments as well.
Yeah, excellent. And moving on from that theme to, we spoke about the other aspects being the variables with new alternatives that are coming into the market, right? And let's talk about the whole buzz around stable coins and tokenized deposits as well. I think that's something that it'll be very interesting for the audience to understand your take on that. Maybe Rich, I can start with you. Where do you see that component within this whole space of correspondent banking? Will that be a complement? Is that a threat? Or is it a sort of a rail that you expect most correspondent banks to start including within the chest of products as well?
Yeah, obviously, stablecoins has been something that has been in the market for some time. It has reached a new level of interest, I would say, probably in the last year. Obviously, when the Genius Act was passed earlier, or in the summer of 2025, that increased awareness, and a lot of our clients, a lot of our banks are coming to us and asking about it. At its simplest form, I think of stablecoin as just another form of liquidity. And I think to your kind of high-level question, it's not a threat. I think it is another tool in the tool chest that we can leverage for certain types of payments and certain types of markets. And I don't think, and really what I think the innovation around stablecoins can be focused on is some of the friction that we have in the correspondent model today, which I see as, and I run into this every day with clients, where I miss the funding window, I don't have enough funds in market, and what do? Or it's a Sunday morning and I've run out of money and payments are stopping, and I've got an e-commerce site and payments still need to get pushed out to sellers, for instance. And so suddenly now you've got a form of liquidity that can have an atomic settlement, real time, 24/7, over the weekend, to be able to support the digital economy where payments just don't happen during banking hours. And I think that's the power of where this technology can lead. It's not going to mean that we I don't see that it's going to be a situation where we're closing our correspondent relationships. But how does this sit alongside that to be able to augment some of the correspondent strategies that you have today? Perhaps it becomes more of a staple in let's say your long tail, where you've got a situation where you've got not as much payments into a particular market to really justify the cost or get the return of that correspondent relationship, but yet you could potentially use a stable coin to be able to clear payments within that particular market. And so, Visa has been heavily investing in this area for some time. One of the things that we're doing within the Visa Direct world itself, which again is the money movement world, is we're really focusing on two primary areas in the use of stablecoins. And this is based on where our clients are asking us and having interest in leveraging this liquidity method. The first is in pre-funding. If you think about how you need to put funding in market to be able to support payment flows, especially for businesses that run 24/7 and have like B2C payouts. Thursday morning you're sending a wire for the weekend, and you're trapping a lot of liquidity in that wire for 3 to 4 days, and there's a cost to that, right? And you can forecast it, and we're very good at forecasting it, but we all know when you have a dynamic digital economy, your forecast can sometimes be under or overperforming, and therefore you've not optimized your capital. Suddenly now, how does a stablecoin allow for a pre-funding method that might be perhaps a bit more just in time than planning 3 or 4 days out? And that can have a real benefit as a tool within the correspondent tool chest. The other side that we are focused on is the payout side. So one of the things that's core to Visa is, pay anyone, anywhere, and how they want to get paid. So this is why we offer in our network today the ability to get to account, to get to card, to get to wallet. A stablecoin wallet is just another wallet. And there are certain markets where that becomes an extreme value proposition for your beneficiary, where there are currency controls or a highly volatile currency, that the ability to receive in a US dollar denominated stablecoin effectively allows them to easily kind of offshore that money and then move that money into market when they need to based on their own schedule or when there's an optimal FX rate. So those are the two areas that Visa is currently working on specifically for a money movement. These are active pilots that we're working on right now with clients in market, and there'll be other enhancements that are on our roadmap that are coming out later this year.
Great, thanks, Rich. Matt, if I could turn it over to you.
Yeah, and it seems to be the most popular question here, written in various forms.
As expected.
Through Slido. Look, I think it's important from my perspective to understand, like, correspondent banking is a model, right, of partnership, right? You have correspondents who help distribute, right, and give you access to different markets, different pay types. Traditionally, that has been one pay type, right, throughout most of my career, right? That's been a wire, and it's done cross-border. Yeah. These new ways, I see it, right? This is just all going to be about optionality. I think, Rich, you touched upon it, right? In different markets, different pay types have become norm, right? In emerging markets in Asia and the rest, the wallet is the number one pay type. Even here in the U.S., right? We probably all use PayPal, Venmo, right, to pay each other. But the reality also is, we were talking about this beforehand, I'm guessing most of you don't keep a lot of money in your PayPal or Venmo account, right? You keep enough to make your one-off payments here or there, but it's not your main source of liquidity. That doesn't mean it's not used for domestic payments, P2P. Will that expand? Possibly. But I look at these questions around like DLT blockchain. I think they're always associated with correspondent banking for this theory that correspondent banking requires this partnership and this network, and distributed allows for this open kind of free market network. My own personal opinion is that just doesn't work. You need regulation, right? You need governance, right? And why is the correspondent banking model, right? I never thought, right, when I started in this business, like Aaron, close to probably 25, 30 years ago, I'd be the one in the white beard on the stage in 2026 talking about the relevance of correspondent banking. But the reality is the model works. Will the endpoints and the way we distribute the funds in the future with new technology and new pay methods look different? 100%. But when you actually scratch underneath the surface of it, the model probably won't look that different. In the future, will I be partnering with a Visa to give me those 50 wallets and things in one connectivity to 50 markets or 100 markets? Yes, that happens today. Right? Will I partner with a local bank that gives me distribution in a central bank digital currency if that's what's necessary? Yes. So to me, the technology will make us more efficient and change the way we do things. And assuming it's all secure, right, which we can't underestimate that security, right? It's all secure. Yeah, we're all continuing to look for different ways and better ways to move the money cross border. But actually, when you look at the model, it will probably look very similar, right? Where we'll have to have those partnerships, those correspondent relationships to give us that reach. Will you need less of them? Yes, probably, because you can get one that can give you many, right? And
Hopefully Visa, by the way.
Right? But that's the reality as well, right? Because you've got some out there, right, larger providers who are trying to globalize and give you one-stop shop.
And to add on to that, I think we were talking about earlier, what do you end up with a digital wallet with 60 different stable coins in it? I've got a Target coin, I've got a Walmart coin, I've got a coin for this, a coin for that. What happens with adoption in different countries to get to maybe the Visa coin, right? Or JP Morgan or whoever else has these coins pre-CBDCs. And I look at it from a business owner perspective that's, I'm assessed on how we do as a business unit and the revenue generate, and a large part of that is foreign exchange. If we move to stablecoin, do we, in essence, eliminate a lot of that FX business, and now it goes to the owners of those stablecoin platforms or stablecoins who are now going to do that on each side of the transaction, eliminating a business line for a lot of banks, right? And narrowing down that field. So these are just things you kind of start to think about. Probably going to happen after I retire, hopefully, but it's a question.
Yeah, and just sort of segueing into another area, and I know we can certainly spend a lot more time on stablecoin, but I also wanted to hear your thoughts on global RTP. Is that something that, Aaron, if I can pose a question to you, is that something that you hear a lot from your clients, your customers, that is that a critical ask, or is that a good to have, or which section do you think of your clients are looking for that?
Yeah, so it's interesting. I kind of look at it as we do have clients that ask for the faster payment to get it there immediately, but not as much as you would think. I think they've been conditioned to the norm. Yeah. And as we start to see things speed up, I think you'll get that optionality. What's going to be interesting is how we present it to the clients. And I kind of look at it as shipping a FedEx, right? Here's your options. If you want it there immediately, it's this. If you want it there in 2 days, it's this. And you allow them to kind of meet you where they want to be. If they want to have it go for free, then it's like it'll get there when it, in a day or two, versus if it needs to be instantaneous, well, we can charge more for that. And have that. But we're not getting we do hear it, but not to the extreme. I would imagine that Matt or Rich might hear it at the larger bank, in that big space where you're, money center kind of world.
Yeah, Matt?
Yeah, I mean, I think we've been hearing it for a while. Obviously, instant payments domestically has been out there for a while. And it's the age-old question, well, why hasn't it just flipped into the cross-border space? And to me, there's some simple, very basic reasons. One, when you build a domestic system, your controls are completely different, right? And once you get into cross-border, you get into sanctions and AML and different risks. And so banks all built instant, most likely domestically, not plugging those controls in because speed was important. And once you put those controls in, the speed aspect becomes a big question, right? It was heavily involved a few years ago, right? The clearinghouse and the European, the EBA were looking to connect their two instant payment systems, right? It made sense. Why can't we get instant into Europe and then instant into the US, leveraging both of their instant domestic systems? And the reality was, technically, within like 6 months, we figured it out. This wasn't a technical challenge. Then it became down to governance, right, and local jurisdiction, right? And why correspondent banking works is because that correspondent bank gives you, right, that local connectivity to the market. When you go into something where you're trying to connect two instant systems, very quickly you don't have that same luxury, which is now I'm paying a bank in Europe who I've done no due diligence on and don't have a relationship with and don't have that same correspondent banking model. It starts falling apart very quickly. And so my belief is, yeah, it will come, but they're all allowing now very slowly the one leg out. The banks then need to all, right, or anybody involved needs to build the right controls,
Right.
which sounds easier said than done because of that speed aspect. Well, what am I going to do when I get the sanctions hit and now I need to settle within 15 seconds? I can't make my sanctions decision in 15 seconds. And then let's not forget the largest challenge we all have out there in this new world, which is fraud, right? Which is fraud, and cross-border fraud, right, is massive, right? And if it settles faster and you don't have the right controls, you get in the same challenges. But it's here. We've got to figure it out, right? But same thing to my earlier point, I think it will use a similar model as those one leg outs apply themselves, right? Your correspondent relationship will offer that up, and you have that optionality when you need it. And it's not needed all the time, but at some point to be competitive end-to-end in every use case, you're going to need that option. It's a requirement. Speed's a requirement.
Sorry, and Rich, you probably see this from a cross-section of your clients, right?
Yeah, and inherently Visa is a real-time network. I mean, the delivery through the card is in real time, although from a cross-border, domestically it's within seconds, within cross-border it's 30 minutes or less, but in practicality it's seconds. Digital wallets are real time. And even the account rails that we have is 85% of those rails are same day or faster. And so it is inherently a real-time network or near real-time network. And it's important to specific customer segments and specific use cases. And so when I look at like a B2B space and invoice payments and things like that, when you get into the middle market and SMB of your client base, the ability to kind of pay this morning and have the invoice get paid this afternoon is about their cash flow. And that presents real value rather than having to plan that 2 or 3 days in advance. The other aspect of that is obviously when you do send an international wire through the current structure, there can be a situation where I have to pay an invoice for 100,000 rupees and I'm guessing at how much I need to send because I don't know the FX rate that's going to be applied. I don't know the fees that will be applied, and the only thing I know when I send the payment is I'm going to be wrong. And I'm going to either overpay or I'm going to underpay, and that creates a whole other set of issues. With the way that Visa approaches those type of payments, you get certainty and transparency in the FX rate and in those fees at the moment you're sending, so you can plan specifically how much you need to send in order to meet your obligation, which can provide a significant value proposition to your customers. I have lots of, I would say regional banks to national banks that are right now actively working on a strategy to kind of what I call right channel international wires into the Visa ecosystem. So looking at a certain segment of wires that are going today that can be channeled into Visa, specifically Visa Direct account, where we're sending directly to an account, to be able to kind of optimize that payment experience for their customer. And not only can they provide the certainty of delivery, the certainty of the fees, the certainty of the amount received in the local currency, but oftentimes it also puts the bank in the driver's seat to get back the FX, which is obviously where they want to be because that's when you earn the most on those transactions. And so instead of allowing it to be the downstream in-country partner that's taking that revenue, or if you have or negotiating a revenue share, it's about taking, your customer is the one that's originating and taking that revenue from your customer rather than allowing it to go to another bank that they don't even have a relationship with. And so that's kind of how I think about it. But going back to the use case perspective, on the consumer side, the B2C side, in the digital economy, this is table stakes. When you look at a seller payout, when you look at a contractor that's on a freelance site, they want to get paid on their own terms. And Visa's done extensive research on this to kind of understand the pain point that a lot of these two-sided marketplaces have from a payments perspective. Many of these two-sided marketplaces are not payment experts. They, with the exception of some very large ones in the US that have a payment function and become very good at it, a lot of these others, they don't have it, so they're looking for solutions in the market. And when an individual goes onto this site, logs in and sees that they've got $500 available for payout because of a job that they complete, they want to hit a button that says, pay me now, and they want their phone to chime because the money just hit their account. And they will actually change the service they are using because of that access to that payment capability. And so if you don't offer that type of real-time access to the payment and maybe also how they want to get paid, like getting paid in that digital wallet, that individual in country won't use that platform. And at the end of the day, if your client is that platform, what do they want? They want more people on their platform. And so payments can become a way to be able to acquire and maintain the retain those customers on the platform.
Excellent, thanks. And I'm conscious of time. So I also wanted to get to, looking to the future, right? And we spoke about the current model, we spoke about the challenges, we spoke about the opportunities. So if we can go around, maybe Aaron, I can start with you. What would you think is the future of correspondent banking in order to ensure that it remains a core pillar of the financial, global financial structure?
Sure. So I would say exciting and ever-changing. I do see a lot of these new technologies that are coming along, and even just talking about the speed and how do we do this, and if you have AI involved with those screenings for OFAC and for other, how does if the regulators say that's okay, well, wow, we can speed that up significantly because we're not having people do that task. So as technology grows and we can adapt it, I think it's going to speed things up, probably make them a little bit safer. And I do think there's space for both the correspondent banking traditional model and moving into more of that stablecoin and what's next as well.
Matt?
Yeah, I mean, I think I echo. It's an encouraging time because I think the technology is going to allow us to do things in different ways, right? With a focus on efficiency, right? Rich mentioned about the focus on how do we maximize the liquidity, right? I've been in the payments business for a while. The payments in the center of all that, and that's why, right? You've got companies that have realized they can differentiate via how they distribute and do their payments, right? Payments has become critical to every bank and every function because it happens every day, everywhere. It's always been much more complex when you get into the cross-border space. But to me, all of these opportunities are just that. They're going to be opportunities. Some of them will become real and possibly mainstream over time. Some will have their waves and disappear. The criticality is you're going to need to have flexibility. That optionality is going to be necessary, the need for speed, right, and the need to do things in different ways depending on what markets your clients are in and what markets they pay into. You're going to need that optionality, right? The old ways of just having one option is not going to be, right, successful, and so you need to have that flexibility, and that your technology needs to be able to adapt to whatever that new technology, that new way is. And so you need to always be thinking about how do you modernize and continue to modernize without knowing what the future is. So you can't modernize going down one path and going, well, I think it's all going to be stablecoin. I'm going to put all my eggs in the stablecoin basket and move that direction because you don't know. It could be that. It could be that and 5 other things. It could be, it's most likely going to be a combination. And so you've got to really build that flexibility and that mindset of don't worry about what 5 years may look like, because if you worry about the unknown, you're always going to be trying to challenge yourself in what to do today. Build flexible systems that give you that optionality and build partnerships that give you that flexibility.
Perfect. Rich, short summary from yourself.
Yeah, I think it is about expanding the reach. I think it is about real time, and I think it's about always-on capability to be able to kind of meet the evolving needs of clients today, as well as the digital economy that is ever present. So,
great. So I think, ladies and gentlemen, we heard several themes come out in this discussion, and if I can summarize, I think what we're hearing is that the basic model of correspondent banking still stays resilient. It's very difficult, honestly, to be able to replicate the governance, the trust, and the regulatory oversight that correspondent bank offers. However, looking to the future, I think in order for correspondent banks to still continue to stay relevant, continue to be at the forefront of providing that landscape and being the enabler for global finance, it needs to be able to ensure adapting to the changing world. We see a lot of alternatives in the market at this point of time. Still early days for a few, but I think what's certain is transparency, speed, all of that is no longer a good to have. I think correspondent banks need to sort of step up, and that becomes a baseline requirement as well as, and it's less about complete reinvention of the model, but more in terms of reinforcing, and as I think a lot of the panelists mentioned, using automation going forward as well. And with that, maybe we'll head into questions. And let me know, who wants to take that.
I could take the top one.
Absolutely.
The mid-tier bank here. It's interesting because I think what we're going to end up seeing is you're going to have to, as the banks ask for more and more of that piece of your small pie, you're going to have to narrow it down to regional and say, I've got 2 to 3 banks that cover Europe, Asia, LATAM, and really focus in on having good, strong partnerships with them so that you aren't at risk of being de-risked eventually. And then I think the other avenue that we have to look at is looking at a Visa, or the other one starts with an M, that I won't take, but looking at those other networks that might give you optionality to be able to say, okay, I don't have to have all my eggs in the correspondent network. I can, have some other channels available as well.
Yeah, that strategy, I see that not only for the regional banks, but I actually even see that for the national banks. They take a similar approach to that. And I think that's really about kind of optimizing your reach and your network.
Mm-hmm.
Yeah, I think I see a number of questions that we kind of addressed as well, but maybe, do you see an immediate threat to correspondent banking given the rise of DLT, blockchain, CBDCs?
I mean, I think that it's just how you define. I think that's always the challenge. I think correspondent banking in general to the population probably outside this room is usually always associated with SWIFT as the main channel, right, for traditionally how it's done. The reality is, right, correspondent banking is a model. Obviously, SWIFT today is the predominant messaging standard, right, and ISO has become the new kind of messaging standard as well, right, for a lot of domestic and other systems, right? So I don't think it's a threat. It's a new way, right? It's a new settlement method, right, that offers new benefits depending on the market you're in. So I think that's where it's always important to understand, like, separating correspondent banking, what it is, what it's been traditionally. Is it going to fundamentally change? No, it's partnerships, right? If you're going to be around the world, you're never going to be everywhere, right? No matter how big you get or how, right? You're always going to need partners, right? Your model is going to be partnership. That's never going to change. Are your partners going to look maybe different than they did in the past? Where traditionally they've been the Visas of the world and banks. Are they going to be fintechs and others? Yes, they probably already have.
Absolutely. And I also wanted to just chime in, and I know we kind of focus a lot on the payment cross-border space as well, but I think we shouldn't lose sight of the fact that trade finance plays a big role as well in the whole global financial markets as well. So I think correspondent banks form a very strong network that most commercial banks, whether regional or international, are looking to sort of leverage as well, right? So I think that continues to be a big space that core banks will continue to add value and provide. And I'm sure there's going to be disruptions in that space as well, with many other applications coming in. But I think safe to say, I think interesting times ahead. But with that, I'll thank all the panelists. Thank you for your views. Hope it was enjoyable to the audience as well.
Thank you.
Thank you.